Hi everyone, my name's Darryl Panes, CEO at As Good as Gold Australia, and this evening once again I'm joined by my brother Brian.
Thank you, Darryl.
Partner at As Good as Gold. And tonight we interview Alasdair Macleod, Head of Research at goldmoney.com and advisor to As Good as Gold Australia. Good evening, Alasdair.
Good morning, or it's good evening, whatever.
Yeah.
Good evening, Alasdair. I was wondering when you're going to answer.
It can be confusing. But unfortunately, there's not a lot of people that we can interview here in Australia, so we get this situation quite regularly, don't we, Brian?
We certainly do.
Lots to talk about. The world is, as I read it, in absolute disarray. But before we get into that, what I'd like to do is just make a brief mention of a very exciting promotion. I mean, going back a couple of weeks ago, Brian and I became very enthused about introducing our product line, opening up As Good as Gold Australia in the US and Canada. And we've got off to a very good start. So we thank our viewers, subscribers for supporting us from 2 weeks ago. But tonight, we thought we'd introduce something that...
Even better.
Even better. I mean, we go back 30 years ago when Brian and I started investing in precious metals, and I remember looking at the spot price and thinking, how is that relevant to what I'm paying for metal? Now, I've since learned exactly why it was relevant, and of course there are numerous processes that take place, that is from the refiner or the mint to produce a product that we eventually end up with in our hands. And so there's a premium one pays for that. But what Brian and I thought we'd do, and we've never had this experience personally, being able to buy a spot from a bullion dealership, but we thought that, and we've worked pretty hard at this, but we've come up with a formula. So tonight, in the United States and in Canada, you will be able to purchase gold at spot. So that's the promotion that we're going to do. How's it work? Well, you know that we're open for business and you can connect with As Good as Gold on our website, of course, www.asgoodasgoldoz.com, and click on the international link. Now, that'll take you to the products that are available to US and Canadian citizens. Now, here's how the offer works. All you need to do is place an order online for 50 ounces of silver. Now, that could be any silver product that is listed on our website. It could be a kangaroo, a silver kangaroo. It could be
American Eagles.
It could be a Britannia. Anything that's listed on our site. So if you placed an order for 50 ounces of silver, you could then add them to your cart, of course, go back to the international product page and order a coin from the same mint. So if it was a silver kangaroo, 50 silver kangaroos, you just order a gold 1 ounce kangaroo coin. And that would be purchased at spot. Once that gold coin has been added to your cart, you'll find the price will automatically drop down at spot. Now this, it's a unique opportunity and one we're really excited about. But if you've ever wanted to purchase gold at spot, this is your opportunity. Now, the catch is there's only 100 people who qualify to do so. It's the first 100 people in the first 48 hours that will qualify to do this. So, some of you might be thinking, okay, does this product have to be shipped from Australia? No, it does not. It'll be shipped out of Las Vegas. And so that delivery, from the moment it's shipped, it'll arrive on your doorstep within 2 to 3 days of shipping. Now, we're excited about this. We'd like to think that you are. I doubt very much whether you've ever been able to purchase gold at spot before, but for 48 hours you'll be able to, or the first 100, whichever comes first. Alrighty, Alasdair, the world, I think, is currently in a very precarious position. Debt mounting to unprecedented levels, governments minting currency like it's just going like there is no tomorrow. We all know historically that this never works. And quite clearly, inflation now is starting to raise its ugly head and have an impact on the standard of living of everyone around the world. I know here that, and it would be the same in the US, food, fuel, transport, property, inflation is everywhere. I want to make reference to a couple of quotes before I ask you the question that I'm seeking an answer from tonight. Gentleman by the name of Vladimir Lenin, former Premier of the Soviet Union, declared this, that the best way to destroy a capitalistic system was to debauch the currency. He said, by the process of ongoing inflation, governments can confiscate secretly and unobserved an important part of the wealth of their citizens. Now, John Maynard Keynes, the very highly decorated English economist, and you refer to John Maynard Keynes, you have previously, agreed with Lenin. And he said there is no subtler nor surer means of overturning the basis of society than to debauch the currency. This process, he said, engages all the hidden forces of economic law on the side of destruction and does so in a manner that not one man in a million can diagnose. Alasdair, I believe this is where we are right in the midst of an inflationary phase that seems to me to be gaining absolute momentum and could quite conceivably, we could lose control. Look, I'd like your thoughts on the two quotes from those two famous gentlemen. And then if you could share with us where you believe inflation is heading now. And what will the process be? How do you believe it's going to take place, and what do you believe the ramifications are going to be as we progress?
How long have you got? The answer is, Lenin was right, and he deployed that process, destroying the currency at the time when there was a sort of brief period between the revolution and Lenin actually assuming his dictatorship of Russia. But he was absolutely right. The destruction of the Russian, I think the currency at the time was a Chervonik, something like that, basically happened at the same time as the European great monetary inflations, Germany, Austria, Hungary, and Poland, I think, at the same time. Anyway, he was absolutely right. It just basically impoverished everybody. And of course, this is very well documented with what happened in Germany. I mean, particularly well documented, and various books have been written on it and so on. So, we have all the stories and all the rest. We know this. There are also people who profit from it, and the people who profit from it tend to be aligned with the state, as it were, with the state or with the state's agents, such as the banking system and so on and so forth. So there's quite a lot of power, amazingly, in favor of monetary inflation. So the whole thing does sort of get going. Keynes made that comment in an earlier book. I think it was The Consequences of the Peace or something. I mean, it was sort of roundabout then, the early 1920s. But of course, later on, he more or less recanted by effectively recommending that inflation be introduced as a means of the state intervening in the economy. And he didn't quite call it that. What he said is that, government should run a deficit, when the free market fails. It clearly shows that he'd moved from a general understanding of markets, which is also reflected in his tract on monetary reform, to a statist stance, and that was with his magnum opus, the general theory. As to where we are now, I think I would draw your attention to a number of very, very important points. The first is the record levels of government debt. The second is the continuing and accelerating rate of monetary inflation. Now, the increase in debt is part of this, because the counterpart to producing money is debt. It's as simple as that. It's like, if you like, a sort of double entry bookkeeping, as it were. If you're going to produce money, you've got to produce debt on the other side. What matters is, how is that debt funded? And the debt is either funded out of savings, in which case people have to put aside money which they would otherwise consume today in order to help fund the government's spending. Now, that plainly is not happening. I mean, if it was happening, you would see that there's a massive increase in the savings ratio. Now, there has been an increase in the savings ratio over the COVID lockdowns, but it's only because people haven't been able to get out and spend their money.
Yes.
Yeah. So we now have a situation where you have record levels of debt, particularly in government. You also have production disruption as a result of COVID. Now, the production disruption comes from a number of sources. The most obvious one is that all the containers were in the wrong places and all the rest of it. And what with lockdowns, production schedules have got all screwed up and so on and so forth. So an economy like the American one, which depends on imports for a very substantial portion of its goods, found that those goods were not being delivered once the lockdown ended and consumer demand to spend all that accumulated false savings, as it were, began to hit the streets. That has driven up prices. It has created shortages. You've also got on-the-ground logistics are also screwed up because, lorry drivers, truck drivers, rail and all the rest of it have been disrupted by COVID, if you like, people having to isolate. I mean, it's hitting this country very, very hard. I mean, you go into a supermarket and there are all sorts of things you'd normally buy in the supermarket are not on the shelves. Why? Because they're not getting delivered to the supermarket. Why they're not getting delivered to the supermarket? The drivers have got COVID, so you've got all these problems. So what you have, in effect, is an explosion of consumer demand, which has just been pent up and has become unlocked, at the same time as you have got severe restrictions on production. And in the background, you have had commodity prices rising. Now, that's stopped for the moment, but, they have risen very substantially. I mean, if you look at an index of commodities, it's not quite, but almost doubled since March 2020. So you got that in the background as well. And most surprising to the economists, our state economists, when you unlock people from COVID and you have given them money to not work, they don't want to go back to work. So you've got a shortage of labor, and businesses are having to advertise for labor and saying, we will pay you $2,000, whatever, just to come to an interview. So the whole thing is completely messed up. The one thing that we know that's coming out of this is that, and we have seen the evidence, that prices are beginning to rise and are rising at a significantly faster pace than they were before. We can argue about what the level of inflation is and all the rest of it, but we put the numbers to one side. The fact is that all these shortages, all these disruptions, against a background, incidentally, of just-in-time working, which has become fashionable throughout industry. So there's no stock on the shelves as a starting point. You can see that this sort of huge imbalance means that this is not a problem that is going to go away tomorrow. I mean, the Fed says it's transitory. No, it is not transitory. I mean, if you talk to the people in the logistics industry, the people who you would respect, who know what they're talking about, like the guys who run shipping companies and sort of freight companies and all the rest of it, they tell us that this isn't going to get sorted out until well into next year. So what are we seeing on the price front? We're seeing prices not only rising, but continuing to rise, and probably rising more sharply than we have seen so far. if you put that into the mix, then there's only one thing that we can conclude out of this, and that is that interest rates must rise. So I return to the debt. What's the effect on the debt? The effect on government debt is that governments will suddenly appear to be bankrupt because they've been funding with their central banks suppressing interest rates to 0 or even -0.5%. If they've suddenly got to pay something that begins to reflect what's going on in prices at their suppressed statistical level, then you're looking at, by the end of this year, we could easily see interest rates in the market, say for 10-year debt, rising to, sort of 5%, 6%. I mean, this is just going to crucify all the spending that's happened and all the spending that is now planned. I mean, even this week, we had President Biden signing in a further $1 trillion of stimulus, basically. And, they're debating another $3.5 trillion of infrastructure spending. I mean, they're spending without limitation.
Yes.
And so you can see that where this train crash is going to happen is going to be interest rates beginning to reflect the fact that the purchasing power of paper currencies is basically in a state, entering a state of collapse. If we turn to business, of course, we have got an awful lot of business that has funded itself out of debt or through debt on the basis that debt is not that expensive. Now, particularly going through corporate bond markets, that sort of thing. I mean, when you get junk bonds yielding no more than, say, 6%, 7%, whatever the rate is, it's called junk for a reason. It's called junk basically because the chances of it ever getting repaid are, well, perhaps not quite 0, but, there's a significant chance that this debt is not going to be repaid. It is required at the very least to be rolled over. So if we have rising interest rates, what's going to happen to all that? We're going to see corporate bankruptcies increasing at a pace. We're going to see the stock market go down the toilet. And the reason for that is that you don't get rising bond yields in this market environment without stocks getting the cue from those bonds. So what does the central bank then do? I mean, the central bank, and if you look at the Fed, has been printing money to support markets. That $120 billion a month goes into pension funds and insurance companies. What it does is it takes out low-risk debt, low-risk government debt, in other words, and agency debt, which is low-yielding, and encourages the pension funds and insurance companies to replace that with corporate debt and with equities. So they will have increased their allocation to equities. When those prices start falling, what does the Fed do? I mean, the sensible thing without this problem is that if the Fed sees rising inflation, then it has to stop printing money. No. What it has to do, unfortunately, is it's got itself into a position where it has to continue to support asset prices. Because if it doesn't support asset prices, what then happens is that banks with collateral, which is basically, the liquid collateral is stocks, bonds, and so on and so forth, owned by the borrowers, which they've put up as collateral against loans, they start falling in value. What do the banks do? They liquidate the collateral. So you have then got a real collapse of financial asset values in train. What does the Fed do? I mean, the answer is it doesn't taper. It can't taper. It has to increase its support for financial assets. So, in other words, they're doing 120 billion now. You get rising interest rates, we're looking like 250 billion a month. And if that doesn't stop it, even more. What does this do to the purchasing power of the currency? It undermines it even more. Yes. So I think that we've got a real problem here. The Fed is probably beginning to understand the problem that it's created for itself. It won't admit it in public, because the moment it admits it in public, basically the whole Ponzi scheme is dead. It's a state of collapse. How do we avoid it? I mean, when you get an asset bubble which has been deliberately inflated by the authorities, then the task you're trying to put yourself is to stop that bubble bursting. And this is why I look back through history, and I sort of try and find things which are sort of common to this current situation to help explain it. And the best one I've come up with, and we've discussed this before, is John Law's France in 1720. Mm-hmm. He took his Mississippi venture and his Banque Royale, which was a prototype central bank, which he set up for the French and controlled. He was also the controller of the currency, which is very handy because it meant that he could issue unbacked livre at any pace he wanted. And what he did was he did a version of QE. And that was he wanted to support, he needed to fund his Mississippi venture because his Mississippi venture gave him a complete monopoly on the import and exports of France, and therefore all the business of French territories outside France. And he needed to build ships. He needed to, sort of get all that infrastructure going. So he needed basically to raise a lot of money. And he did this through share issues. And he did it basically by creating a bubble to get people to buy the shares. And there came a point where the bubble started to sort of falter. And at that point, he then started buying shares by printing livre, by printing the currency, which he had responsibility for as controller of the currency. Now, this meant that in 1720, the shares, it failed to sustain the shares, incidentally. The shares peaked at around about 10,000 livre in February, early March 1720. By around about the following August, going to September, it had fallen to 4,000 livre. Now, not a huge fall. I mean, we would regard that as a normal bear market, if you like, in an equity market. But the sting in the tail was what happened to the livre. And the livre basically fell on the foreign exchanges in London and Amsterdam, which were the two main foreign exchanges at those times. They fell from some value to nothing. There was no quote for the livre in September 1720. So you might have shares worth 4,000 livre, but the livre itself is worthless. And the person who played this correctly, and he made about 3 fortunes out of this thing, incidentally, was a guy called Richard Cantillon, who was an Irish-French banker. He was really Irish, but he had a cousin, Richard Cantillon, who was known as the Chevalier Cantillon, who actually had a bank in Paris. He went into partnership with him in around about 1710 and so on. Cantillon was a very shrewd guy. And he his last fortune on this, in around about 1719, late 1719, I mean, he knew the whole thing was a bubble. He knew that this was just a scam and all the rest of it. And so how did he play it? Well, he didn't go and short the shares. No. What he'd already done is he'd taken, people who wanted to buy shares and wanted to borrow money. He lent them the money and then without telling them, sold the shares in the market. And incidentally, after that, he then went after them for the money that was owed to him and got it. So he made 2 bites out of that cherry. But when it came to the tail end of 1719, before the whole thing collapsed, what he did was he went out and sold every livre he could get his hands on in London and Amsterdam. That was his final fortune. He then he made so many enemies. He left France and settled in London, where unfortunately, he then wrote his essay, which was an absolute classic on economics. It's of its time insofar as it's an essay really about the economics of the time, which was very much agricultural and so on and so forth. But he understood things like why prices rise and all the rest of it. He was a very canny man. Unfortunately, he died or he disappeared. His house in Mayfair caught fire one night and everything in it was destroyed. They didn't find his body, and of course, there are all sorts of wonderful rumors that he sort of escaped with his fortune and disappeared into Latin America. Anyway, that's beside the point. The point is that is, if you like, a laboratory run through for what's happening now. The John Law experience is now a global phenomenon in the making. So the idea that the progression of the loss of purchasing power of paper currencies is going to copy what we have seen so often before, from Germany 1920-23 to Venezuela today to Zimbabwe and so on, is actually the wrong model. What we've got to look at is a model which collapses the currency because it has been used and fully committed to supporting asset values. It's when that fails that the currency fails in its wake. So this is apart from the horrors and all the rest of it that this is likely to introduce us to, it is a fascinating time as a theoretician, like me is concerned. This is the most interesting period I could ever live through.
Yeah, look, this, I think you would have enjoyed a conversation that we had with a gentleman a couple of days ago who was the son of our lifetime mentor, Peter Daniels. I asked him where he thought this was all heading, and he said there is no way of avoiding the disaster that lies ahead. No way of avoiding it. All one can do is prepare. And there are ways of doing that, but we're going to have the experience. And as he said, it'll be the biggest disaster of our lifetime. Now, pretty heavy words, but I think that's where we're heading.
Well, I think the thing that's interesting is that I think people are beginning to wake up to it. I think you're right. Sort of very, very shrewd hedge fund managers over here, for example, are beginning to say that, the Fed cannot permit interest rates to rise. Now, they're only seeing half the story, or they're only saying half the story, but they're beginning to see the danger, I think, that, where do we go from here? They can see the dynamics behind it, but they haven't yet worked out the whole thing. So this is a process which we're beginning to see work through. And the other thing that's interesting to me is that, going back to your quote that Keynes made about not one man in a million understands what's happening with money.
I was going to bring this up again, yeah.
This is not quite true today, because you have got a whole cadre of millennials and, the Z generation who, are playing Bitcoin and Ethereum and so on. Why are they doing that? They're doing that because they've learned that the difference between the two is that there is a restriction on the quantity of Bitcoin, like it grows to 21 or 22 million, whatever the figure is. Whereas what you're pricing it in, which is fiat currency, is completely limitless, and governments are deploying the money tree as much as they possibly can. So, this is why Bitcoin has gone from 16 cents to currently $46,000. And so you've got, people are a lot more aware today, I think. Not everybody, but they are more aware of what governments are doing to money today than they have probably ever been in the past. Now, it will probably take some sort of trigger for that light bulb moment for them to say, oh my goodness, it is actually happening. Now, because this is important, because when that happens, people do start dumping currency for anything. And they realize that currency has no value whatsoever. They just get rid of it as quickly as they can. Now, this is an interesting one, because if you go back to the Germany example in 1920-23, in those days, you couldn't get rid of your currency until you were effectively paid by your employer. So what you would do is you would get paid, and probably daily at this stage, the later stages, because the purchasing power is just going down and down and down. But it meant that you had to leave your factory or whatever it was, go to your bank, put in your employer's check, take out, marks, and then go and spend it before they lost any more value. So this is a process that took, a day or two at least. Now, of course, we don't have those restrictions. We have credit cards and all the rest of it. And so what we can do is we can literally just or we can go online and just spend our deposits in the bank immediately. Yes. And, any credit we've got, we can go and spend immediately. So this will have an effect in terms of the speed at which this realization, this light bulb moment, is translated into a loss of purchasing power for the currency. And I think that, again, when we go back to the John Law experience, there's another thing that's interesting, and that is that the shares and the currency didn't fall at the same time. The shares fell first. The currency sort of stayed at a level of purchasing power for a while before finally it just went. And I think what that tells us is that in a crisis today, a collapse of financial asset values, what you're likely to see, I think, is people may be going into currency, cash, if you like. We just got to get out, which basically means that they will sell what they can for cash. So that, if you like, is a moment of stability for the currency. Mm-hmm. But then everybody's got cash and they don't want it because they realize what's actually happening to the purchasing power of the cash. So you can see that that might be relevant to today. So what we could see is the collapse in asset values before you see the collapse in the currency. But then after a period of time, and it's probably going to be no more than a few months, I think, you will see the currency go down as well. And the reason I think that it will happen more quickly is partly because, sort of modern financial systems are a lot more efficient, a lot quicker, and all the rest of it. You don't have to get round to the bank in order to put your paycheck in and draw the money out and then go and find somewhere to spend it. And, so things are definitely, can happen a lot more quickly. But I think that, you've got to sort of put yourself in the minds of individuals going through this process. They will see at this stage Bitcoin will probably be over $100,000 or something. They will see the gold price probably going through $3,000, silver through, I don't know, $120 or something, whatever. I mean, the levels don't actually matter, but they will see these prices rising and they will work out in their own minds actually what's happening to currency.
Yeah. Yep.
And this, I think, at some stage there will be that second light bulb moment, where, holding, the first one is holding my shares in Microsoft or, Google or whatever, was actually the wrong thing to do. I should have sold those while I could. I'm now selling them for a tenth of what I could have sold them. That's the first light bulb moment. The second one is about the currency. And so I can see that you're going to have almost this sort of two-phase thing. I don't think it's going to take as long once it gets going as the John Law situation, for the reasons I've stated. I would guess that once we see asset values begin to fall, then we have probably got, if you like, that sort of in-between bit, which might last a month, 2 months, 3 months at the outside. The importance in this, of course, is that how do you protect yourself? And I think, viewers to this will be not surprised to hear that my view, quite simply, is that you protect yourself by having physical gold, physical silver, which is why, Darryl, your offer, I think, is so timely, if you like, particularly since we're recording this at the end of a week when they smashed the gold price, when markets were effectively closed. Then you get this moment sort of late on a Sunday night when you can trade, but there's nobody trading. So if you're going to really shift the gold price, that's when you have a crack at it. And they did this with silver. When the first time silver went up towards $50, I think it was 2012, around about then. 2011, 2012. That again was an overnight job, just like we saw this week. And I think if I'm right in saying that at the same time, Japan was closed for a public holiday. In the Far East, I think that Singapore was closed for a public holiday. So, but I mean, the fact is that the buyers were, they were in bed, tucked up asleep, or not back from their holiday, their sort of weekend and so on. So we have seen exactly the same situation. I think that's produced an extraordinary opportunity, if you can get hold of it, to get physical bullion. I mean, I want to go on record thanking the bullion banks for hitting the price so that I could buy more. This is, I'm so grateful to them. I really am.
Well, I concur.
It's a positive way of looking at it.
It's a fabulous opportunity for people to take advantage of. I mean, we can all say, well, the gold and silver prices have been depressed, but that creates an opportunity. I agree 100%. Yeah.
Alasdair, look, on that note, I'm going to ask the next question, and as typical as I do, I put a few facts and figures out there, then I ask the question. But it is based around what we've just been talking about this last week. And basically the takedown of gold and silver started on Wednesday the 4th to Monday the 9th, or Monday our time, Sunday night on the weekend in London and New York. I've got some figures here, because I couldn't believe it when I was having breakfast on Monday morning, what my eyes were seeing. It was outstanding, but I had to go back a few days. And the figures of what I'm going to present is what the lead up to all of this Sunday night, Monday morning, what was happening. So on Wednesday the 4th, August the 4th, the private employment numbers came out in the United States. They were expecting 650,000 and they received 375,000, so a shortfall of around about 300,000. So it started off, the US price of gold started off at 1,812. It went immediately up to 1,830 after these results were put out, and came within a couple of hours straight back down again to actually finished at 1,808. Now, that was Wednesday, so it didn't do anything. You might as well say it stood still, gold, right? Friday, 2 days later, August the 6th. The government employment numbers. So the other ones were private. The next ones are the government employment numbers. US Labor Department. Expected increase of 870,000 jobs, received 940,000 jobs. So unexpected increase of 70,000. Wacko! So here we go. Gold started off at 1,800 dollars an ounce. It stayed at 1,800 for a few minutes and then bottomed for that day on the Friday of 1,763. And so roughly a drop of $40 because employment figures were actually a little bit better. But these were government employment figures, not private ones. Now, this is the humdum of it all. This is where the crux comes in. Sunday night, Monday morning. Now, I'll let you know that in Adelaide, when I was having my breakfast around 7:30 in the morning, I got this wild shock on my phone when I had a look at the figures. But in New York, it was 7:30 p.m. Sunday night. London, midnight. Asia, 5 a.m. in the morning. And this is what happened. It started off at 1763 as of the Friday. It topped at 1763, went down to 1680, but within 2 hours after hitting 1680, it came back to 1740. Next $60 increase in dollar terms in about 2 hours. Now, my question is going to be here, and I think a lot of people want to know this. At that hour in the morning, or at night on a Sunday night, the markets are closed, gold drops $80 per ounce. Who buys these paper contracts at 5 o'clock in the morning or at midnight on Sunday night? Can you tell me, Alasdair?
Well, this is why they do it at that time, because, the buyers just, they're not there. I mean, the market is only notionally open, but the traders aren't there at all. So that is the time to do it, if you're going to do it. But clearly, this was manipulation, because anyone who seriously wanted to sell some gold, and we're talking, I think, around about $4 billion worth US was, the sort of figures that I see mentioned. You don't, go into a market with a view to getting a low price for it. You go into a market when there are buyers there to absorb it. I mean, why take a loss? The reason all this has happened, I think, is to do with the Basel III regulations, because they have come into America and Europe as of the end of June. So July was the first month whereby these regulations applied to bank accounting. I sort of looked at the bank participation figures, which are released by the CFTC on a monthly basis. It's basically the first weekend, if you like, of the month. And the interesting thing is that over July, what happened was that the banks, and this basically is the majority of the traders in the swaps category on COMEX, the banks increased their longs in July by 8,383 contracts. But interestingly, they increased their shorts even more. They increased by 24,094. So what does this mean? What it means is that in the month when these bullion banks would be under pressure from their management to reduce their outstanding positions, actually found that their positions increased. Their short positions increased. I mean, they increased by a net 16,000 contracts. So what do they do about it? Well, the answer is just try and bash the market and make the figures look a bit better as far as they're concerned. And that, I think, was why this actually happened. And of course, this time of year is, in the Northern Hemisphere, we tend to be on holiday. You guys down there are probably working because it's winter. But, up here, August is holiday time. The kids are out of school and all the rest of it. So, you go along to your beach house or, whatever facility you've got. This is a good time, basically, to do this sort of thing. Now, the reason that gold and silver prices just haven't sort of suddenly recovered back to where they were, sort of the previous Wednesday, as you're pointing out, it was over $1,800, is because there just isn't the interest in the market to do that. The other thing is that I've explained, if you like, the effect on COMEX, which has basically been a failure as an operation. But in London, you have got ETF holders, both in gold and silver. The ETF holders are characterized by a reasonable portion of them being the sort of smaller private investors. By smaller, I mean they probably own less than £20,000 worth, say $40,000, $50,000 worth. Now, these are the people who are likely to be scared out of a position if, as the ringmaster in the whole thing, you can arrange things to make people scared. And so there is no doubt that, one of the things that Basel III basically does is it changes the whole of the derivative scenario, if you like, of forwards and swaps in London into a physical market. Now, obviously, it's not going to happen overnight, but good progress is going to have to be made by the end of this year, because in London, Basel III will apply from January next year. So these banks need to, if you like, sort themselves out. They can scare out smaller holders of ETFs. That's about the only source of gold in any significant quantities they can get their hands on. And stored in London, we've got, I suppose, roughly 1,600 tons of ETF gold, something like it's a figure like that. There is coming into the market probably about 8 or 9 tons daily from non-Asian sources. which come through the refiners, as it were, who will sort of hedge the position. Stuff comes in, they hedge the price by selling it forward, if you like, in the market, and that's one of the things that goes on. But where we found this particularly the case was in silver. And this is interesting because the silver price has not really recovered. It is still down while gold has bounced. And I would put this down to the attempt back in February or February, of various people in the silver market to encourage a Robin Hood raid, if you like, on the silver shorts by getting them to buy ETFs, silver ETFs. Now, it was fine at the time. It drove the price up, I think, on February the 1st to just briefly touch $30. But the problem is that in the process, they've created a lot of weak ETF holders. And those are the people who are selling now. And that is why there is more physical liquidity in the silver market in London than is the case in gold. And I think that explains what's happened to those two things. So, this sort of short-term attempt to try and sort of, by the bulls who are getting so frustrated with the bullion banks' behavior to try and rig the market against the bullion banks, I'm afraid it's backfiring on them now. So this is something which I expected to be a danger at the time. And I was invited by various people to get involved with, sort of supporting, a move into physical silver and all the rest of it. And, I'm sort of very happy to talk about what's going on in the market, but I didn't want to be part of that promotion. It's not my function anyway to go and promote things. So it's rather I'm an analyst. And I think this is, it's the reason that silver is now so weak. And this is an opportunity, as we were discussing earlier. It is an opportunity, I think, for people who genuinely understand what they're doing to go in and buy physical metal. And I would like to reiterate one point, and this is so important. The majority of people we end up dealing with in this business are investors, or they have got an investor mentality. In other words, they're thinking in terms, let's say, Australian dollars, that I buy gold or silver at a price in Australian dollars. I'm looking at my profit measured in Australian dollars, and I will eventually sell it for Australian dollars. No, that is not what you should be doing. You do that buying BHP or any investment or even government bonds or whatever for a yield. Fine, you do that. That's an investment. That is proper investment. What we're talking about here is hedging against the possibility, and it's an increasing likelihood, of a collapse of the purchasing power of paper currency. And by a collapse, I don't mean just a gentle long-term decline, which you can manage your way out of by having assets that inflate at a slightly faster pace than the decline in the purchasing power or dollars, whatever. No, what we're talking about is getting out of the paper currency system, which is on the verge of collapse. And what you will do is you will end up spending your gold and silver. This is not an investment. It is money. And there is a very important difference, which I think is so important for people to really understand.
Thank you very much, Alasdair. It's a great answer for the question. I am going to end the question off with only bit of good news I heard today. It's from a bank, Wells Fargo. There's not many good news comes out of banks. But this particular gentleman from Wells Fargo, I'm going to read it out to you. He talks about being spooked out of the $300 drop just recently. He said, gold has had a rough 12 months. At least on a relative basis. The average commodity using the Bloomberg Commodity Index is up 34% since August of 2020, while the gold spot price is down 12%. Does this spook us? No. He's talking about us being the bank. Does this spook us? No, not really, said Wells Fargo head of real asset strategy, John Laforge. Gold is expected to resume its leadership position in the current bullish cycle, Lafarge added, and the spark behind the renewed rally in gold will most likely be China. So very, very interesting comments. Alasdair, my last question, and I think you've partly answered it, but here we go anyway. We'll just see if there's any more to add. Why does, and it's about silver, ladies and gentlemen, why does silver get treated like a monetary metal when gold gets a beating, but does not rise like an industrial metal with an improvement in the labour market? Shouldn't it be rising with other commodity materials like oil, copper, battery metals?
The answer is, yeah. I mean, it should be rising with other commodity metals. But we have a system, and the system basically is one of bullion banks who don't like to see prices rise. It means they've got to hedge the whole time. And okay, if their customers hedge, that's fine because the banks can go short to them. You've got to bear in mind that the banks act like jobbers, and the jobbers always run a short book. So they don't want to see a rising price. I mean, it's interesting that various commentators over the years, in explaining the relationship between the London market and COMEX, say that in London they have long positions which they then hedge by going short on COMEX. It's absolute rubbish. The jobbers are speculating. They are jobbing. They are providing liquidity into the market, if you want to put a nice gloss on it. And they do that by going short. So they don't want to see prices rising. Every chance they can get to put a damper on rising prices, they will do. So it's for that reason that the price of silver does not behave like you think it should do. There is another aspect of this which is sort of getting into economics a bit and the theories of prices and so on. If silver was priced as a monetary metal, then it would have a relationship which history tells us is somewhere under 20 ounces to 1 ounce of gold. I mean, it was fixed by Isaac Newton around about 15 and a half, 16 ounces, something like that. Now, so that would imply, with the current gold price, that the price for silver should be considerably higher. I think that it's not being priced as a monetary metal, but there is some sort of premium in it for its potential to be priced as a monetary metal. And we've seen this vary. I mean, back in March last year, it hit 120. The gold-silver ratio hit 120, which put in more understandable language means that there are 120 ounces of silver for each ounce of gold. Now it is around about 74, 75. Having been down as low as I think something like 66 or 67.
Correct.
So that's, there is obviously, having gone from 120 down to virtually halving, it's outperformed gold at that stage to the point where you can definitely say that there was a monetary premium coming into silver. That I think has obviously been hit by these events in the last few days, but there is still a premium in there, I would say, over purely industrial use. And indeed, if you look at vaulted silver, there is a sort of fairly significant amount of silver which is vaulted, and it's in ETFs and so on and so forth, which would otherwise be industrial. So you can see there's definitely a demand element there, which reflects investment or a use other than industrial. So I think you have to look at it in that light slightly. You've got this sort of two-way pull. As fiat currencies collapse, if you like, the use of silver as a monetary metal will return. Of that, I have absolutely no doubt. And the reason for saying this is that even a relatively small gold coin is not, something that you can walk into a shop with, as it were, and go and buy it because it's
very
far
true.
too big. How are you going to get the change? You can't get change in even smaller gold coins. So silver, if you like, will be the more practical money when fiat currency goes. And I think that it's what it means is that the price in fiat currencies of silver in a fiat currency collapse will move far more quickly than the price of gold. So what you're likely to see is that that gold-silver relationship will return back towards the 20 from the current 75. So, what we're looking at is probably the price of silver rising at a rate somewhere between 2 and 3 times that of the price of gold, going through that monetary collapse. It will accelerate, in my view.
Darryl?
I think Alasdair's given everybody a lot of reasons to purchase silver. I mean, it's really in this environment the ultimate form of protection against a collapsing currency. That's really what we have to look at, and it's very much like Egon von Greyerz would make reference to the same. How much would you invest in precious metals today? Whatever you can't afford to lose. I think these are really strong, valid points.
And everybody can afford a bit of silver.
Yeah.
At the price it's so low at the moment.
And we're getting feedback all the time, aren't we, Brian?
Yeah.
There are more and more people, Alasdair, that are contacting us and saying, other than precious metals, we don't know what to do. And most of them have started to do some research, and there's there's more information out there now than there ever has been. So, if you want the answers, what do I do from here? That information is available. It's available from people like Alasdair Macleod.
Yeah.
The Charlie Tremendous Joneses of this world who said, the people you meet in the books you read, they impact on your life more than you could ever imagine, right? You've got to look for good sound information, and we've got it tonight with Alasdair. Alasdair, once again, I just thank you so much for your input. You're wonderfully researched, and it's just great to have you as an advisor to As Good as Gold Australia. We really appreciate your input. I'd also like to thank our viewers and subscribers for continuing to support this channel. Don't forget that exciting opportunity that's available to you tonight. Gold at spot. Can't provide you silver at spot tonight, but gold at spot, wonderful opportunity. Until next time, stay well, stay focused, and goodbye for now.
Goodbye for now.